3, 2, 1.
Okay.
You guys are watching this after Thanksgiving. Well, it was after Thanksgiving for us, too. Hope you guys had a great Thanksgiving.
Absolutely.
I am still stuffed.
So the day before Thanksgiving, do you know what day that is?
The biggest party day of the year?
Well, it was when I was in college, I can tell you that. But it was November 23rd. What is November 23rd? 1123. Fibonacci Day.
Yeah, that's right. You did
It's
put that up on
Fibonacci
Facebook.
Day.
I
Yeah.
should have remembered that. I was like, what the hell? I know I should know the answer.
You add 1 and 1, you get 2. You add 2 and 1, you get 3. Unfortunately, it didn't keep on going. But yeah,
that's hilarious.
It's Fibonacci Day.
You know you're a geek when.
Yeah, seriously.
You know when Fibonacci Day is.
Scary that half my Facebook feed filled up with Happy Fibonacci Day on Wednesday. But hey, so I'll take that geek monicum. And actually, I'll have to throw out props to Jen London, who emailed me earlier in the week that, hey, FYI, Fibonacci Day's coming up. So thanks, Jen.
What do you got for this week?
So
I promise I haven't been drinking. I just hadn't had enough coffee this morning. I'm like stepping all over my words. I'm like, I need some more coffee.
So what we're going to do this week, a lot of people have been asking, and what we're going to do is fixed income. I'm going to try to make it as
there's a lot of talk about this right now.
There is.
Just because of the way the market's going.
Right.
So you hear a lot of this blah, blah, blah. And I remember, 10 years ago, whatever, I had no clue what the hell fixed income meant.
Yeah. Fixed income is actually much bigger. So bonds generally is what they mean when they say fixed income. And the bond market is like 10 times bigger than the stock market. But we're going to kind of focus on how we could use it in terms of both TSP and the mutual fund window, and if you were in a brokerage account outside.
Cool.
And then kind of talk through that a little bit. So fixed income. What exactly is fixed income? So it broadly refers to investment securities that pay investors a dividend, right, until the maturity date. So basically what happens is you give a company or the government or a municipality or whatever, say $1,000, right? At the end of the term, say it's 5 years, they'll give you your $1,000 back. And in the meantime, let's say it was a 5% bond, you'll get $50 a year as a dividend, basically. It's not called a dividend;
right.
That's a stock term, but it's the rate that you get. It's the yield that you get.
It's guaranteed.
It's guaranteed.
It's not fluctuating. It's written into the bond when you buy it.
Right.
It's like a contract that says I'm going to guarantee you 5% on your money if you give me that money.
Right.
And theoretically, it's secure. If you're talking about government bonds, theoretically it's secure because the municipality or the state or the federal government are backing it.
Right.
So, they're pretty, low risk. And then corporate bonds, though,
a little bit risky,
a little different.
Right. If you buy an Apple bond versus you buy Upstart bond, so you get a better rate of return. Like everything else, you get a better rate of return the riskier you get, right? And we're going to kind of get into that a little bit. So at maturity, investors are repaid the principal that they invested, right? Government and corporate bonds are the most common types of fixed income products. So when we talk about 2-year treasuries and 10-year treasuries and 20-plus year treasuries, that's what that is, government treasury bonds. So unlike equities that pay out no cash flows to investors, where payments can change based on underlying measures such as short-term interest rates, the payments of a fixed income security are known in advance. So like we said, it's in the contract. If you do a 5-year, you buy a 5-year bond, after that 5 years, you get your principal back.
Right.
Now, inflation obviously affects that because $1,000 today might be worth less.
So if you buy a 10-year, 20-year bond,
you're going to get the face value back. Yeah. So if you buy a $1,000 bond, you're going to get that $1,000 back in 10 years, but the value of that $1,000 in 10 years is probably much less, right? Which is supposed to be sort of offset by the yield that you get.
The yield,
right?
Yep. And it's more or less what people do to preserve wealth when you're talking about like institutional wealth, large wealthy entities, people, whatever. They'll go towards bonds not to make money off of, but to basically hold. Like I'm not going to put it in a checking account, but I'll put it in a bond that I'm going to get 6% on,
right?
And then that's going to help me kind of hedge inflation,
right?
And keep that money
right
in there, right? So it's not really meant to get 20% returns or all that. They're not looking to get big numbers from that,
right? The other side of that right now, though, is that if you buy, like the short-term rate, it's not 5% yet, but it's pretty close. So let's say the rate is 5%. As the rate goes up, the price of the bond goes down, right? So if you buy a bond where the rate is 5%, then the price is relatively low because the yields have come up. So the price is going down, so the price is relatively low. So if you buy it at 5%, you take your $1,000, you buy a 5% bond, you've locked in that yield that you're going to get every year for 5 years, right? Then if yields come down, the price goes up. So you've already locked in the yield you're going to get, right? So you're guaranteed to get that yield.
Right.
Then as yields come down, the price of the bond goes up. So you can lock in a high yield and get the capital gain on the bond when you go to sell it.
Right.
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 So, and you don't have to hold it to maturity.
Right. You won't sell it at $1,000 in this scenario.
Right.
Right. Because the value of the bond is going up. You'll still only get $1,000 back if you wait to the end, right?
That's right. If you wait to maturity.
If you sell it,
right,
it could be worth more
much
during
more
that
than
time.
right.
Exactly. And that person is buying it. Let's say it's $1,500. You bought it for $1,000. I sell it to you for $1,500. You're buying that my 5%.
Right.
Which they can't get at that point.
Right.
Right.
That's why the price goes up.
Yeah. Exactly.
Yeah.
So there's definitely we're kind of getting real into the weeds of it, but it's a lot of people don't understand bonds.
Right.
I mean, I didn't understand bonds until a few years ago, and didn't understand the value. When you're living in a world with the stock market's skyrocketing, you don't care about bonds. Right now, everybody cares about bonds.
Right. Right.
So
everybody's trying to protect what they have and trying to make a little bit. But right now, there's a pretty good opportunity, and I don't know about right now today, but
in the near future.
In the near future, and that's why we've been talking about the F fund for, the last couple of months. That I'm really focused on the F fund because it's so undervalued on a long-term basis that at some point, it's really going to go.
That's not. It's just not you saying that. No. Like if you're paying attention, guys, gals, watch. If you're watching this, I hope you're watching other things. And you should start to hear now when people are talking about fixed income and bonds, why they're talking about it. Why is it such a big deal right now? It's because there is a potential for a huge opportunity coming, where we're at a point when they're all so undervalued that, of course, that's the time to buy it.
Right.
And then uniquely, we now have this mutual fund window that we have, so that makes some of these tools available to us that wouldn't normally be available. Right. We always had the F fund.
Yes.
But a lot of people would just poo-poo the F fund. They were like, I would never be in the F fund. Right. Well, if you were us in 2008, you were 18.
Right. 18 we were, and it was good because
decades messed up.
We were able to get some gains rather than just being in the G fund. We were able to get some gains in the F fund, but we also didn't obviously take the losses from the stock funds.
Yep.
All right, so let's
do it.
So, in addition to purchasing fixed income securities directly, there are several fixed income ETFs and mutual funds available to investors. So, we're going to take a look at one of each of those, actually. And if you
because you're not actually buying the bond, then.
Well, we're going to show how you can buy the bond, and how you can buy a bond fund. And the F fund.
Let's do it.
So three different things, but they relate.
I like it.
All right.
I'm excited.
I'm glad you're excited about bonds because, God. So fixed income pros and cons, right? You get steady income, which is the yield that we talked about, right? Definitely more stable. It's not as volatile as stock returns. This is a big one if you have a lot of money. You are much higher up on the list. If a company goes bankrupt and if you buy Apple bonds and Apple was to go bankrupt, you would get your money back before shareholders of Apple stock gets their money back. And then government and FDIC backing on some, certainly not all, but some government bonds. So there's a lot less risk in the bond market than there is in the stock market. The cons, of course, on the other side of that, returns are lower, right? Your Apple bond is not going to return the kind of growth that you saw in Apple stock. Credit and default risk exposure, that is true. The credit market, obviously, when the Fed messes with rates, it affects the bond prices. So that's really interest rate risk, and there's definitely inflation risk, because if you buy $1,000 10-year bond, when inflation takes over, the value of your $1,000 in 10 years is not what it is today. So there's definitely inflation risk in bonds. All right. So a pretty simple example. So say you buy, so Pepsi issues a fixed rate bond, which means it's going to give you that rate of return every year that you own the bond. So it's an IOU. So they are issuing a bond so that they can, build a new bottling plant in Argentina. They issue a 5% bond. It's available at face value of $1,000 each. It's due minimum 5 years to maturity. So that's kind of what we've been talking about here. You buy a $1,000 bond. It's got a 5-year maturity window. Okay, company plans to use the proceed to pay for the debt on this new plant that they're building in Argentina. So you buy 10 bonds. Okay, it costs you $10,000. You're going to get $500 in yield in interest payments every year for 5 years. Okay. So the interest amount is fixed and gives you a steady income. So if you just stop, you give them the $10,000, you bought 10 bonds, gave them the $10,000, you're going to get $500 a year for the next 5 years, unless Pepsi goes bankrupt. So the interest amount is fixed, gives you a steady income. Company receives $10,000 and uses the funds to build their plant. Upon maturity in 5 years, the company pays you back the principal, the $10,000, right? And you earned $2,500 over the course of that 5 years in $500 a year increments. Okay? So you put up $10,000, you earned $2,500 over that 5 years, and you got your $10,000 back. And it's not guaranteed because Pepsi isn't the government, but it's pretty close to being guaranteed because Pepsi isn't going anywhere. So that's basically how it works. So the bottom line, fixed income refers to debt investments that pay a fixed rate of interest along with the return of the principal that you lent to them in the first place, right? Includes different types of bonds and certificates of deposit. We're going to look at that real quick. Fixed income is an asset class, is generally less volatile than stocks. It's considered to be more conservative. A well-diversified portfolio should have some allocation of fixed income that becomes increasingly larger as one's time horizon shortens. I left it in here. I don't necessarily agree, but that's the diversification concept of why you want to have bonds or fixed income in your portfolio. All right. So bonds. All right. How do I buy a bond? Actually, the next slide is how do I buy a bond? There are basically 5 types of bonds. Okay. If you go, the next couple slides are coming from fidelity.com. Okay. So I just logged into my account and looked at how I would buy bonds if I wanted to do it. So you got U.S. Treasury bonds, agency, which are essentially GSEs, which are like mortgage-backed securities. That's essentially what that is. They should just come out and tell you it's basically mortgage-backed securities. And this is kind of interesting if you go down that rabbit hole, but debt obligations issued by agencies of the government or private agencies called government-sponsored enterprises, which are federally chartered but publicly owned by shareholders. So they're not a government agency.
That's like your Sallie Mae, Fannie Mae.
Sallie Mae, Fannie Mae, yeah. So it's student loans, mortgage-backed securities. It's things that I have to force myself not to think about because it drives me crazy. The government should either be the government and corporate should be corporate, but these things
they're in the middle.
They straddle the line, and so they're getting paid no matter what. It drives me nuts.
Yeah.
Municipal, right? City, county, state. Whenever you go to vote, every time I go to vote, they're always asking, "Do you want us to take out a bond to build a new school or stand up a new police department or whatever?" Mm-hmm. That's what that is. Corporate is Apple. If you want to buy, fully taxable debt. So there's a lot of differences between these kinds of bonds. Municipal bonds are taxed in a different way than treasuries, and corporate is always fully taxable. So fully taxable debt obligations issued by corporations to fund some kind of capital improvement or expansion, build a new plant in China or whatever. And then high yield. High yield is kind of interesting. We're not really going to go into it, but high yield, if you follow high yield debt, it talks about the relative risk in the market at the time. But high yield debt securities are rated below investment grade because the company is relatively weak. So you're getting a much higher yield, right? 1% interest. You're going to get paid more, but the company is weaker. So Apple bonds would not be considered high yield. Upstart bonds probably would be considered high yield. If you don't know what I keep referring to Upstart, UPST is the ticker symbol. Go check it out. It's the chart is pretty hysterical. Okay, so if you wanted to buy bonds, how would you do it? In Fidelity, you would go to Home, Research, Fixed Income, right? And it'll take you to the screen. And it'll tell you all about bonds. All these different tabs down here give you a ton of information, what the yield is about. There is 68,000 bonds you could buy. You get new issues. You don't have to just buy a bond. You can buy them in ladders, right? If you bought a 2-year, a 5-year, and a 10-year, then obviously the maturity rates are different. So you're going to get different rates of return on those different years, and as they roll off, you can ladder your way into a relatively less risky kind of guaranteed income flow. So that's what you would do. You would go to Fidelity there. If you go a little bit lower on that one page, this kind of lays out where it is right now in terms of yield. So a treasury bond, right? A 3-month treasury bond gives you 4.43% on an annual basis. So it's not like you're getting 4.43% over 3 months. You're getting it over the course of the year, okay? But your money is only locked up for 3 months, okay? You're not seeing it. All right. Can you see it now? That's not good.
Yeah, the screen froze. Now we got it back.
Oh, you got it back?
Well, I'm seeing that.
That's interesting. What are you seeing now?
Yep, I see fixed income bonds and CDs, that one.
Yep.
Yeah, you must have hit that one by accident.
That's unfortunate.
Yeah, can you unhide it there?
I don't know.
Sorry, guys, a little technical difficulties.
A little technical problem here. I have no idea where I would hide it from or to.
All right, we won't be able to fix it.
All right. Anyway, you go. So what are you seeing right now? That one.
The first one before it. This one.
Yeah.
You can write on there. I don't know.
Right on there. Okay. So it's okay. It's basically examples of the kinds of bonds you can buy right now, and you're still seeing that same page, right? Yeah.
No. We're having
there's technical difficulties we're working through. No problem.
Your tablet's not playing with us well. There we go. Got it back.
Interesting.
Yeah.
So it's just completely not.
Yep.
Yeah. Okay. So it's not like in that slide, and so I'm just gonna kind of explain it to you a little bit. So basically, this was a list. The slide has a list of the different kinds of bonds: treasury, agency, corporates, municipal, and they give different rates of return over different time frames. So you just go to that and you look at it and you go like, all right, if I want to lock in a 5%, agency GSE rate of return, I understand that the risk is somewhere between U.S. Treasuries and corporate, and I'm not too worried about the risk over the 5-year term, and so I'll lock in my 5%, and then if the Fed reduces the rates, the value of my bond is going to go up, so I don't have to hold it for the 5 years. I can sell it, and these are the kinds of thought processes that you would go through if you wanted to do it. So obviously this doesn't apply in TSP because we don't have this. But if you wanted to buy bonds outside, if you have money outside of TSP,
yep.
And you're worried about the stock market, this is you have like all the.
You can do it within your IRA, and if you have access to it, you can do it in your 401k.
Yep. All right. So that's bonds. If you were going to go out to Treasury Direct through Fidelity, for example, that's how you would buy the actual bond. Okay. So the next thing we're going to do. Okay, good. This is working. Is bond funds. Okay. This is more in line with what we can do in terms of TSP, and if you don't want to go to buy bonds directly. So the first one is TLT, and we've definitely talked about that before. It's an ETF that tracks the 20-plus year Treasury bond. Okay, so it's down 31.5% year to date. So what you're doing when you buy the bond fund is just like any other ETF. You're trading the chart that's in front of you. There's no yield. There's no none of it. You're trading the chart that's in front of you right there. So the idea is that at some point when there's ordinarily, if you're in a 60-40 portfolio, the reason you have it is because when stocks are going up, bonds are flat to down, and when stocks are going down, bonds are going up or flat, and so they sort of balance each other out. The TLT is the long-term Treasury bond. When in this next, as we move forward here, if we get a recession and all that, when the stock market tanks, long-term Treasuries should go way up because people should flee equities into the safety of long-term bonds. Right. That's the idea. We keep talking about the F fund because that's our only play in this environment. But if you have money outside of TSP, the TLT is what everybody is looking at right now. Mm-hmm. So that's the TLT. Inside the mutual fund window, okay, you can do. This is the closest that I could find to a TLT play inside the mutual fund window. Vanguard Long-Term Index Fund Admiral Shares. Okay, it's not the 20+ years; it's the 10+ years, but it's pretty close, right? So the fund employs an indexing investment approach designed to track the performance of the Bloomberg Long-Term Treasury Bond Index. Index includes fixed income securities issued by the Treasury with maturities greater than 10 years. So again, TLT is greater than 20 years, VLGSX greater than 10 years, but it's pretty close. Because long-term bonds tend to be very sensitive to interest rate changes, one of the fund's key risks is that increases in interest rates may reduce the price of the bonds in the portfolio. So we know that from the last slide, the TLT, year to date, we're down 31.5%. Why is that? Because the Fed has been raising interest rates. So because long-term bonds tend to be very sensitive to interest rate changes, one of the fund's key risks is that increases in interest rates may reduce the price of the bonds in the portfolio. And that's what we've seen this year, which reduces the fund's share price, right? Investors who are looking for a fund that seeks to provide interest income and are able to tolerate significant interest rate risk may wish to consider this fund. If you think that rates have gone way up, which they have, and they're peaking because inflation is peaking and the Fed is going to have to pivot and rates are going to come down, the VLGSX is going to explode higher. If all those things happen, then in the mutual fund window, whatever you put in there into VLGSX, you should do very well.
Right.
That's the thesis. Okay, and that's the TLT, and it's the VLGSX. F fund, it's the best we can do. It's a combination of corporate and government treasuries. It's only down 13.58% year to date, and you might say, well, wouldn't it be better to be in the F fund? Not from the perspective of this thesis, because you're not down as much, so you're probably not going to run higher as much. But when the Fed does pivot, but it's all we have in the core TSP funds. So those are the three and how you would kind of play it. And here's a chart of all three of them, right? So the orange is the F fund. Okay, F fund is outperforming, here in 2021, and then in 2022 they all tanked together. Okay. But you can see the orange is AGG, is the F fund. The blue is the TLT, which is a 20-year Treasury bond long term, and the red, which you can see that it's in there. But when I say it's very close to the TLT, I mean it pretty much tracks exactly the TLT. Okay, so don't be too concerned in the mutual fund window that VLGSX is 10 plus year treasuries and TLT is 20 plus year.
Because it seems to track pretty closely regardless.
It's almost exact. Yeah.
Yeah.
So don't, it's pretty close. Don't worry about that. The F fund, not so much. You can see that there's definitely some divergence between the F fund because it's a lot of it is corporate bonds and treasury bonds. So there's no corporate in the VLGSX or the TLT. But this is the only chart that I have for this. But this decline, we've talked about it on like every show for I don't know how long. It's the biggest correction in bonds in like the last couple hundred years. So at some point, is this the bottom? Is it in? And we go higher from here? Who knows? But at some point when the bottom is in, it's going to go much higher from here.
But and I don't want to go too far sideways, but looking at this chart, we're always talking about risk reward, right? Your risk tolerance levels. Walk us through, like, if someone's listening to this and then they decide, you know what, I'm going to put a chunk into this because I kind of buy into this thesis that Jerry's talking about. What's your downside risk right now based on that chart?
On this chart?
Yeah.
So the easiest way to look at it is if price goes below that double bottom, it's probably going lower.
Right.
That's my line in the sand. Right. Now you're going to take a hit. If you bought it here and it goes higher, that's great. But if you buy it here, you have to accept that you're not going to sell it unless it closes below this line.
That's your window right there.
That's your risk.
Those are your two lines in the sand. Now, what's the other line?
The upside
is a pretty nice line.
I mean, you can definitely, the next resistance level is here.
Yeah.
And if you get past that, you're
screaming.
Yeah. I mean, you're making 50% on your money right there.
Yeah. And I think that's important. That's why I brought it up, because I want people to kind of take away from this. Okay. Because we're always talking about these charts, and more now, I think we're doing a better job. You are doing a better job of kind of showing, like, okay, if we do this, this is the kind of the risk we're taking. And that's that little, folks, take a screenshot with your phone or whatever. Like, that's the important takeaway from all the things Jerry just told you, right? Is if you are thinking about taking looking at this as an option in any of your portfolios, whether it's TSP and you go in the mutual fund, it's F fund, this is what you're going to be watching, right? So if you do this, snapshot this thing and be paying attention to it, because now you have lines in the sand. He just drew them.
Yeah.
He just tells you that's all you need to focus on if you have money in either of those three options is those red lines for now, right?
Yeah.
Until things change again. If it goes below that November low there, then get out. If it goes up and passes that 120 line there from August, we're screaming.
Yeah.
Right now, if it doesn't, if it bumps up against it
and rolls over, maybe you sell it.
Things are changing. Yeah. Right. The trend has changed. Anyway, take just a learning moment there.
Yep. Absolutely. Yep. It's a good one. Okay. So that is bonds, right? Both bonds and bond funds. The last one we want to do is CDs. So what's the difference between a CD and a bond? So a CD is available from a bank or a credit union. Okay? That's the biggest difference. You are lending money to a bank or a credit union rather than the government or a corporation.
The funny thing is, when I was growing up, I mean, this is all my grandparents talked about at the time. CDs, buying CDs.
Yeah.
And it was their way, as I look back on it, because they were in the stock funds too back then. But that was they were doing the 60-40, right? And a lot of their 40 was CDs. Yeah. Because in their mind, they trusted the bank.
Yes, yeah.
They just they've had this relationship with the bank for 20 years. I'm just going to buy one of their CDs. It was a trust thing more than it was a financial decision, I think.
Yeah, no, I think a lot of people are still in that same boat.
Yeah.
And I think the bank,
trust banks more than
the bank takes advantage of it.
Yeah.
Right? And we're going to show that on the next slide, actually, because we'll get to it. They take advantage of you. CDs are available from banks and function like savings accounts, right? But they offer a slightly higher rate of interest than your savings account does. In return, The holder agrees to let the issuing financial you agree to let the bank keep your money and use it for that set period of time. Okay, the period of time can be as short as 6 months, as long as 10 years. Extended holding periods offer a higher rate of interest.
Unlike a savings account where, like, I can go get it anytime I want. Right. Savings account, I'm getting a little bit of interest in there, but I can go get it anytime. This is telling the bank I'm not going to take it out for 3 months, 6 months, whatever the CD is, and you can do with it what you will. Right. You just got to give it back to me at the end of that if I want it.
Yes. Yeah. Right. It's like a bond in that way, right? Yeah. You're just lending it to the bank instead of lending it to a company. Yeah, they just renamed
bond from a bank.
Same kind of idea. Let me see if there's anything important else in here before I go on to this rant. But yeah, one thing is you do get FDIC insurance
up to $250,
up to $250,000. So that's if you're very, very risk averse and you want to get a little bit more than the savings account rate of return, and you don't need the money right now, you could do a CD, and you'd know that you don't. If it's less than $250,000, you're going to get your principal back.
I see this play out in people that I know that are retired, and they're on fixed income. That term meaning something very different than we were just talking about with the bonds. But again, kind of the same principle is they're just trying to preserve. They're just scared to death. I don't want to lose my money because I got to live off this, but I've got X amount in there, and then they don't have millions. Right. So 250,000 is a number that's in their world. That's like, okay, I can't lose this 250. I'm going to buy some CDs and protect it.
There's nothing wrong with that.
Yeah, it depends on your come from. It depends on your situation and your risk tolerance. We're always talking about that.
It's all that.
These tools exist for different reasons because somebody needs them. Yep. Well, I would say that
wants them.
Yeah, I would say the bank needs them more than we do.
Yeah.
But anyway, keep going.
Yeah. So FDIC insurance is a plus. One risk investors face with the CD is inflation. Obviously, this year, when we get to the next slide, you're going to see it. But this year, a CD isn't going to come anywhere close to keeping up with inflation. No matter whether you get out to a 10-year CD, it's not even going to come close. CD interest rates rise with inflation rate because the bank must offer yada yada. Okay. So in short, a CD is a great place to park your money if you don't need it without fear that it will disappear because it's FDIC insured. At worst, the money won't grow as fast as inflation. So that's the worst case, is that you're going to lose to inflation. So I don't know about you guys, but what drives me nuts in the very few times that I walk into an actual bank, there's giant banners
always
about how much, what their rate is for a credit card, a home loan, a car loan, or this or that. It's always like 6, the best rate ever, 5.5, 6.8, 12 point whatever, right? And then in little fine other small little posters they'll have up there is the CDs, and the CD rates of return are like, so 1 year, you give the bank your money for a year, and this is from USAA. Okay, so USAA CD deposit rates of return as of a couple days ago. 1 year, 0.03%. So you've given the bank your money for a year. You can't withdraw it. They can do whatever they want with it. They can get whatever rate of return they can get, and you're going to get 0.03 after that year. 7 years, you're going to get 2.02%. I mean,
but a super jumbo CD, you could give them $175,000.
Yeah, you can give them
7 years.
Yeah,
and then
they're happy to take 2%. More of your money, and they give you the same rate of return.
You guys are probably hearing the sarcasm in our voice here.
Yeah, I mean,
if you have $175,000, please don't give it to a bank for a certificate of deposit. Please don't.
I mean, buy an Apple bond. Apple is not going anywhere.
Right.
Like buy a Treasury bond, anything. Yeah. I mean, unfortunately, the one slide that we couldn't show shows that the bonds right now are ranging from like 4 to 5%.
But if you remember when we were, I wouldn't say kids, but maybe teenagers in early 20s, those signs you were talking about with those rates were huge.
Oh, yeah.
Right? They were pumping them to buy CDs.
It might happen
again. And now
again.
the signs have gotten smaller because they know how ridiculous it is.
Dude, I saw a Toyota commercial yesterday, right? Ordinarily over Christmas time, they're trying to sell cars. They put the bow and like the Santa thing and all that, right? And it seems like over Christmas, and certainly like during 2008 and times when the markets are tanking, the rates come down to zero. They're like, zero interest rate,
0.0 financing.
Right. It was 3.4%, and I'm like, the market's tanking, and the Fed is raising rates, and you're trying to sell a $100,000 car, truck, at a 3.4% rate, and trying to feed it to people like it's a good thing for them.
Yeah.
I mean, I get it. I get
the truck,
where it all goes.
The truck.
Yeah.
That's the problem.
Yeah. I don't know. I think at this point in the game, I would have thought that Toyota would be at 0% financing like it was in 2008, just to get people to buy the trucks, because we get so much unemployment that is coming. Maybe it's next year. Maybe it's next year that we'll see it.
Maybe it's back down there.
But
you just want a truck and you don't want to pay 3%.
I want a van. I want a camper van. That's what I want. I want a truck. Anyway, okay, that is hopefully anybody who was asking, which there are a lot of people asking about fixed income, hopefully that answered some of the questions about fixed income and how you would do it both in.
Yeah, takeaway is this is very useful, tool if used properly, much like all asset classes, right? Yep. The reason these things exist, and we're all about the education. That's what we do this for, right? Is to educate people, and so we just try to put some context to it, where you could easily go read that stuff on Investopedia or Fidelity or wherever you want to read it. But we're trying to put some context to it, so hopefully it helps you guys kind of make decisions, because bonds could be your friends here in the next few years.
Don't discount the F fund. If you're a TSP investor, you're a government employee, you don't have money outside of TSP, and you're just looking to maximize your TSP, don't count out the F fund over the next year to two.
Yeah. Just watch the show.
Yeah.
We'll tell you.
Yeah. And for not for nothing, but we our last reallocation was 50% F fund, 25% I fund. And when we get to the charts here in a second, you'll kind of see why. But a couple of weeks ago, we've been talking for months about the F fund, and
starting to play
again,
out.
we think it matters. So TSP fund charts. It's a 3-year weekly. Again, once you get above that 20-week moving average line, the line acts as support, right, all the way through until January of this year, when it failed. And then ever since then, it can't quite hold above that line. And here's where we are right now. Okay. So the big question is for the C fund, can we stay above that 20-week moving average line? Let's zoom in here for a little bit. 2 weeks ago, we had a huge move up in the C fund, and we closed right about 40.25. And we closed above that 20-week moving average line. And then last week, there was some volatility. We came down, we tested it. You can see the bottom of that wick. We tested the 20-week moving average line, and then rallied higher and finished essentially where we closed. So it was a flat week in terms of price. And then this week, we came down again, tagged that 20-week moving average line, and finished at the top of the week's trading range at 40.26. So for the past 3 weeks, we're getting support above that line. It doesn't mean the market can't roll over and go lower. But if you are only looking at TSP on a weekly basis, you've got 3 weeks now where the price is above that 20-week moving average line. So the next thing you might look at is if we draw a trend line, once we get above that trend line, it'll give you even more assurance that price is going to continue to rally higher. So it just depends on how much assurance you need, or what your risk-reward tolerance is when you're going to get back into the stock funds. We are just barely above 50 on RSI on a weekly basis. MACD has already crossed positive. So if you're not back in the stock funds at this point, I would argue not that you should necessarily, because the market could certainly. I mean, I'm looking at the chart. The macro indicators are horrible, right? Everybody expects recession next year and all these horrible things happening. I'm just looking at the chart that we're looking at right now. The 20-week moving average line is clearly has flattened and is turning higher. Okay, so from a technical analysis perspective, there is no reason that you should not be buying this. There's every reason to buy this chart. Okay, I'm not saying to go out and buy it. I'm just saying from a technical analysis perspective, there's every reason to buy this chart. Okay, S fund, not as good, right? We're not at relative new highs. We're not above 50 RSI. MACD has crossed positive, but that histogram isn't really increasing. It's kind of flat. So the F fund might just be, or the S fund might just be consolidating here, and it could move higher. The good thing about where the S fund is right now is the risk reward. So if your bottom line is to sell below that 20-week moving average line, then we're just barely above it. We've been above it for 3 weeks. So you could buy it there, and if you sold it below that line, your risk is low. Your potential loss is low, but your potential upside is at least back up to the prior high. So from a risk reward perspective, this is actually a better place than the C fund. I fund, huge breakout 3 weeks ago. At some point during that week, actually I don't have the exact date in front of me, but at some point, if you're a subscriber to the site, we got back into the I fund right there when it broke above on a daily basis. But we've done really well on the I fund in the past couple of weeks. It was flat last week and had a big run this week. It's up 2.31%. So there are a lot of people out there that don't like the F fund and don't like the I fund. I don't like or dislike any of these funds. I want to be in the ones that the chart tells me are more likely to go up versus the other ones. So we're well above 50 on the RSI. MACD has crossed, and is the angle of ascent on the I fund is pretty strong. So again, if you're not a subscriber to the site, I don't know what you're waiting for, because we break this down to a daily basis. If you're a subscriber, and you get alerts that tell you exactly when we're moving within our personal TSP accounts. F fund was another one. Huge. We've talked about it. We've been looking at this bottom. We got into the F fund back here. We had a couple of good weeks. We're now bumping up against that 20-week moving average line. We're not above 50 on relative strength, and MACD just gave us one positive week. So it'll be very interesting to see if the F fund can get back above that 20-week moving average line. It's hitting resistance here at that line. So there's some pretty big resistance there. So if it gets through it, it'll be very bullish. But we shall see. All right. I think
you got to do that last slide.
I know.
Questions.
I know that's your cue.
That's for me to know. All right. Hope you guys enjoyed that little discussion about fixed income. If you went to sleep, I'm sorry, but it's important stuff. So a lot of people ask us about it.
I think this is going to be one of those shows that people go back to and look at. It's going to take a while for it to sink in, but I actually think it was one of the better ones. There's a lot of good information in there,
especially for the times that we're in and what's coming and what we think is coming. What, you got to have plans, and if bonds aren't part of your plan right now, you're probably missing out.
Bonds have corrected. I've heard all kinds of different numbers, but since the late 1700s, we haven't seen a bond fall off like this since the late 1700s.
That's crazy.
So there's another. I think, in fact, I know I put this out a couple of weeks ago in the group, in the Facebook group. The rate of yield increase on the Fed funds rate from 1980 something, it took 40 years basically for the rate increase, the increase from that took 40 years to happened in the last year and a half. I don't know how else to describe it. Maybe next week I'll throw up the chart again.
Yeah.
But on a logarithmic scale, so on a percentage basis, it took 40 years for the gain to happen, and it took 18 months for it to happen since 2021 really.
Right.
So I'll bring it back and throw the chart up next week, but it's important because things are going to break because of that. 2023 is not going to be as crazy as 22 was. 23 is the rate hikes that we've already had, and the unemployment that's in motion is going to make 23 much more of an interesting year than 22 was.
Thanks for the doom and gloom, Jerry.
I'm not saying it's all going to roll over and crash. I'm saying it's going to be interesting. To be honest, I don't know if it's going to roll over and crash.
I think the huge takeaway for me, and this is what I keep telling people, is you've been able to get away with keeping your head in the sand for probably 10 years now, just give or take, right? Since 2008, 9, somewhere in there, right? You just been able to get away with it.
Yeah, definitely.
You can't. If you do, you're just going to be one of those folks that's just stuck. With half their retirement gone and, no plan, and just don't be that person, right? I mean, if you are in this, if you're watching this show, you're either in the military or in the government, just don't be that guy or gal that just sticks your head in the sand and or listen to people that have absolutely no idea what they're talking about. Go start watching things like Wealthy on YouTube. Hopefully you're watching this show, and go get yourself educated so you can make some good decisions over the next 10 years. Yeah. I'm not even limited to 23. I mean, the next 10 years are going to be important to all of us. And what's crazy is people are always asking me, like, you're retired. Like, why do you care about all this? Like, I care more now than I did when I was 30.
Oh, yeah.
Because it matters more. Because I'd like to keep accumulating something. And I'd also like to protect what I have. Yeah. What little that may be, it's mine. I don't want to give it away. Yeah. And so these times are very important regardless of your age. And if you have any questions about this stuff, you can hit us up wherever you found this video. You can put it in the comments section. If there isn't a comment section, you can send us an email to support at growmytsp.com. And, we'll do our best to keep track of it and get back to you. Yep. That's where we get a lot of ideas for the show. So in the comment sections. Yep. And I hope you guys had a great Thanksgiving. Hope everybody is getting prepared for the holidays. And we will see you soon.
And we're going to have Scott Zane an appearance next weekend.
Yeah, that interview's coming up.
Yep.
And
out of here.
Are we out? Cue music.